30 seconds for people to log in, and then we'll begin. Thanks. Hello and welcome to the first webinar in a quarterly series brought to you by Nasdaq and Brown Flynn entitled Modern Due Diligence, How Financial Markets Are Analyzing and Incorporating Non-Financial Corporate Performance Data. Our special guests for this webinar include BlackRock and Bloomberg, and we'll go ahead and get started. So a few webinar logistics. All registrant phone lines are in listen-only mode during the presentation. At any time, you can type a question into the message box, and we will try to address the questions during the question and answer session. And if you're experiencing any technical difficulties at any time during the webinar, please call either of the numbers that you see on the screen. And just before we begin, a disclosure. So the views and opinions expressed here are those of the authors and do not represent the views of Nasdaq or any of its affiliates and do not constitute financial advice and should not be taken as such. And with that, I will give it to Evan Harvey to give us the introduction. Evan?
Thanks, Marissa. My name is Evan Harvey. I'm the Managing Director of Corporate Responsibility here at Nasdaq. It's my pleasure to welcome all the attendees to the first web seminar of 2015. This is a quarterly series, primarily for the issuer audience, but we open it up to anybody who's interested, focusing on ESG issues and sustainability as they affect the exchange space and as they affect the issuer community and as they affect investors. Basically looking at best practices and bringing experts together from lots of different disciplines to discuss ways to make progress in this field. I think we have a terrific panel today, and I think we're focusing in on some core issues today, a great way to set the tone for the rest of the year. But if you like this webinar and you enjoy your participation and you get something out of it, please pay attention to the scheduling for future, because we will be doing one a quarter, focusing on slightly different topics as we move through the year. For those of you who don't know why we're doing this, we are in the business of providing outreach and education for listed companies on all kinds of topics, not least of which is sustainability and environmental, social, and governance practices. We believe that good companies manage this data. They internalize it, they operationalize it, they turn it into strategy, and in some cases they turn it into public discourse with investors and other stakeholders, and we want to educate companies on the right way forward. There are lots of different forces in the economic world, as you will hear on this call, that are looking at this data, and they're scrutinizing the performance of companies in this area in different ways. And we thought it was really useful in this call to talk to some of them about the perceptions of ESG, both within and without companies and within and without the stock exchange. So we'll get into more of the detail on that as we move forward. We're very pleased to be working with Brown Flynn, who has a long track record in this space. And our moderator for the discussion today will be Mike Wallace, who's a Managing Director at Brown Flynn. So I'll throw it over to Mike now to make some introductions and to tee up the conversation.
Great. Thank you very much, Evan, for the nice introduction and for allowing us to partner with Nasdaq on this precedent-setting series of webinars like this. Also want to thank our panelists that are with us today. We have some great experts. Miguel from Nasdaq, who's a responsible investment and ESG research analyst. Michelle Adkins, from a managing director from the global head of corporate governance and responsible investment at BlackRock, and Morgan Tarrant from Bloomberg, an ESG data analyst. As Evan mentioned, I'm a managing director of Brown Flynn, a corporate responsibility and sustainability consultancy. We provide a lot of varied services to clients who are trying to find their way through this kind of crazy mode of sustainability and corporate responsibility that's occurring across the globe. And so as part of that, I want to take you on a quick little tour of what's going on in the marketplace and kind of set the stage for today's discussions. As Marissa mentioned, this webinar is being recorded, and we will also make the slides available to any of those that are interested. Please make contact with us. But in general, what we're talking about is not so simple to just define. If you look out there across the world and the way things are being discussed in this space, lots of people are throwing around lots of different language. And in our particular situation, the title of this webinar about non-financial disclosure, all of these things could be considered under that umbrella of non-financial disclosure. If you dissect some of these terms a little bit more, you start to look at some very specific metrics or aspects or indicators, words that we throw around in this field quite a lot. And the idea of sustainability, in many cases, people feel that it really just relates to environmental issues. But as you can see here, when you map it to things like the Global Reporting Initiative or work that's being done by SASB or things that are being discussed by the International Integrated Reporting Council, etc., there are lots of other topics that fall under these different buckets: environmental, human rights, labor practices, economic issues, societal issues, and product responsibility. Many times when talking to companies that are new at this, they don't realize that there's so much more to this idea of sustainability or corporate responsibility. And when they see this slide, they feel fairly overwhelmed. How can I possibly talk about all these things in the public domain? I don't even know what many of these things mean to my company. Well, actually, if you look around the world, you also see that there are a lot of entities doing this. This is just a small sample of the thousands of organizations out there that are now regularly, and most of them annually, measuring, managing, and disclosing sustainability information, what also might be called in the investor community environmental, social, and governance information. Even if you look up in the right-hand corner, you see some public agencies, the U.S. Postal Service, the City of Chicago, even the London Olympics and future Olympics are reporting on the footprint of the event. When you look at this slide, don't just look at the companies themselves and think about if they're a competitor or not. Think about the supply chains that are involved now, too, because this is now starting to affect everybody in the world. It's not just a matter of whether or not you're listed on Nasdaq or NYSE or LSE, or if you're just a publicly traded company out there. This is affecting everyone because it's rolling through supply chains very much the way Total Quality Management did, ISO did, and other various initiatives that relate to your suppliers. Here are some examples of the companies out there in the world that are not only measuring, managing, and disclosing their own sustainability performance, but they're also now looking at their suppliers, asking large, small, public and private companies to measure, manage, and report. And in fact, in a couple of cases we know of, Puma and Intel per se, both of those entities are actively training up large groups of suppliers and teaching those suppliers how to measure, manage, and disclose this information. And again, those are public and private entities. And Intel and Puma is basically saying to these suppliers, we would like to see you report on material sustainability issues by a certain date. So as we go a little deeper, who really cares? Well, a lot of people care. I mean, you're probably hearing it in your own city. Your mayors are probably talking about it. Places where your kids are going to school, deans of universities are talking about it. Universities are measuring their own footprint and teaching sustainability. Customers are asking about it. Suppliers are asking about it. The list goes on and on and on, and it's not going to stop. This field has literally been active for more than 40 years in different shapes and forms, and it's just getting more and more serious as we move forward. For today's discussion, we're particularly interested in the investor component here, so we're going to go a little bit deeper into that. If you were to look out across the world and look up something called socially responsible investment or impact investing, you would probably quickly come across the Global Sustainable Investment Alliance. It's made up of these 7 organizations you see on the left side of your screen. And if you really want to just get right to the nitty-gritty detail, you would look up their latest report, the 2014 report, and in that report you would find the details globally as well as down to the level of dollars invested and how it's growing over time. Global sustainable investing assets grew more than 61% from 2012 to 2014. That's a pretty significant jump. Now, the more critical audiences in this field or in business might say, well, that's that small little group of investors that they're very interested in this socially responsible investment, but I have a fiduciary duty to make sure that my shareholders are honored for their investments, and so I, as the chief executive, need to focus on the important things. Well, if that's the true case, the chief executive, the CFO, and the investor relations officer might also want to tune into these other investor coalitions. We've never before seen in the history of society this large grouping of investors come together on a common issue. And the common issue is, quite frankly, is just transparency. As an investor, I want to see more information from you. I'm very interested in the makeup of your board. very interested in the way that you're treating your people. I'm very interested in whether or not you're considering the climate risks that are on the horizon for you. Should climate be changing and should sea levels be rising? If you're in a drought-stricken area, etc. Please let me know that you're thinking about these things and you're weaving them into your risk management. Also, along the way, because more and more activities getting the interest of so many different people, we're seeing stock exchanges take more action, and Evan and Nasdaq will talk a little bit more about this in a moment. We're seeing international regulatory bodies get more engaged from China and India and Brazil. Even the European Commission now putting a directive in place where all companies that are above 600 employees will need to report on material ESG issues. And even here in the U.S., the federal agencies, U.S. Council on Environmental Quality, the White House Council on Environmental Quality, the General Services Administration, which is the procurement arm of the federal government, Security Exchange Commission, all are dabbling in this area of sustainability or corporate responsibility. And again, if you're a large, small, public or private company, you might very well be somewhere in the supply chain of the U.S. government. Not only is the U.S. government looking at its suppliers, but many of the U.S. states are doing the same thing in many U.S. cities. This is not just happening in the U.S. This is happening around Europe, around Asia, around South America as well. And then, because of this interest, more and more professional societies are starting to take note and starting to help train up their members. If you are a lawyer, you join the American Bar Association. If you're a director or an officer of a corporation, you join the National Association of Corporate Directors. All of these organizations are starting to try and figure out how sustainability relates to them as an organization and how it relates to their profession and their members. So you might very well be able to tune into some of these organizations and get some of the latest information there, as well as turning back to people like Nasdaq and Evan and Miguel, or firms like ours, Brown Flynn. Conversation and Q&A will start now with some discussions with the panelists. And as I mentioned earlier, we have two gentlemen from Nasdaq, Michelle from BlackRock, we have Morgan from Bloomberg, and I'll be moderating us through this discussion. We will be taking questions online, so you can certainly write in and ask me any kind of question you like, and I'll get to it. But you are all on mute. And so with this, I would like to turn it over to Evan for a little bit of an update on what's happening at the top of the Federation, the World Federation of Exchanges. Evan, can you give us a little briefing on what's been going on over there?
I can. It sounds very impressive, the Federation. But for those of you who don't know, the World Federation of Exchanges is the only trade association that connects all of the stock exchanges in the world. It's really the only convening body that we have for stock exchanges around the world. We have stock exchanges that are participating in some other global groups, and we could talk about those a bit later. But the World Federation is really the only one that we've been working through consistently for the last couple of years. And Nasdaq is very privileged to chair the Sustainability Working Group at the World Federation of Exchanges. And this working group is a conglomerate of 19 or 20, I think we're up to 20 exchanges. We just had a couple of additions last week. Exchanges of all sizes and just about across all economic and size parts of the spectrum. We have Nasdaq and NYSE. We have the exchanges in India. We have China and Japan, lots of European. We have some of our more progressive exchanges in South America and in Africa. So it's a very diverse group, and the commitment to come together for this working group was really just to try and drive consensus on what exchanges are doing. Are we all, I mean, some exchanges, as you know, have a listing rule related to ESG. That is not a one-size-fits-all approach that all exchanges are interested in. A lot of exchanges do best practice guidance and education and outreach for issuers, like this webinar. You know, we try to put information in front of issuers to give them the tools to do better at this, independent of any kind of regulatory effort. That is on the table. But really the midterm deliverable for that group is to come up with a guidance document that will be looked at by all the exchanges in the world and perhaps adopted and pushed back out to the exchanges to work with their regulator to implement. It will be a document that basically says we've looked at the issues of environmental, social, and governance reporting. We find that these metrics or these particular data points are most informative. They give us the best long-term insight into the health of a company. And companies should be, if not internalizing and managing that data, disclosing it. Different exchanges will solicit that data in different ways, but you know, the point will be we're trying to come to an industry-specific sense of consensus about what is the most valuable metric to evaluate. And I think that that's going to put better data into the mix for investors. I think that's going to put better data into the mix for markets. I think that regulators and companies and issuers will have a more substantive and engaged conversation based on the presence of this data. So that's the future state, and that's what exchanges are trying to stay in front of. There are some drivers here that we think are particularly valuable in terms of creating long-term capital and eliminating some of the frustrations with short-termism. Sustainability and sustainability reporting might be an avenue through that morass. So that's why we're working together. I think it's the exciting development, Mike, because we didn't have a lot of cooperation in this space on this topic up until 4 or 5 years ago, and now it's everybody seems to have come to the table at once to try and find a way forward. So that's really exciting.
That's great, Evan. And I want to ask a couple more questions about that so we can dig into this a bit more. Here's Nasdaq with several thousand listed companies. The other exchanges have similar numbers of large groups of companies listed on their various exchanges. And there have been some studies out there to look at the transparency of the companies on various exchanges. How is Nasdaq looking at its own companies?
We do the same. I mean, we have participated through the working group in those macro studies looking at the transparency rates and the reporting standards that are present in the listed company universe at other exchanges. Nasdaq actually does pretty well in those macro studies. We have 83+% of our listed companies, as Mike said, over 3,000, provide some kind of ESG data out there publicly. 57% actually provide enough to warrant some sort of evaluation and ESG rating of some kind, according to a couple of outside parties. That's pretty good, and that's a little bit above average comparatively, even though you might say, well, that's a little bit more than half. That means that half are not doing enough. Well, that's true. But more than half is a better track record than some of the other exchanges. However, in Nasdaq's case in particular, we have not been able to correlate as a connection between the rate of disclosure and financial outperformance. We have some studies that seem to indicate that high-performing ESG companies and more disclosure-oriented companies are outperforming the market, are doing a lot of things that are attractive to investors. There's less shareholder turnover. There's some anecdotal evidence around that from other researchers in other markets. We haven't been able to get there yet for our market, and it's not for lack of trying. We're always trying to look at different ways to slice and dice the data. So I'll speak to Nasdaq's performance there. We looked at all of the exchanges in the sustainability working group, and as I said, our numbers were slightly above average. But you also have smaller markets. You have some of these exchanges like Brazil and Johannesburg and Singapore, where they have more mandated disclosure requirements, and they have much smaller markets. So if you're dealing with 300 companies, getting 300 companies to participate in something is a lot different than 3,000. But they also have a sort of a longer track record with this, and they have been able to draw some connections between financial outperformance and this disclosure methodology. So that's an interesting development. And then before we leave this entirely, Mike, I wanted to mention there's a parallel effort that's out there at the United Nations called the Sustainable Stock Exchange Initiative, has many of the same stock exchanges participating, has many of the same goals, and we're working this year, in fact, we had a conversation this morning, we're working this year to find ways to collaborate together on shared outcomes. I think that you have the sort of large global engagement of the United Nations working with stock exchanges around the world to drive better information in the public eye, and you have stock exchanges working at it from a business or exchange-centric point of view. It's interesting and I think enlightening to find that they have found a way to work together and work towards a common goal. And not to go on, but when you talk about the number of exchanges that are in the WFE, it's something like 95% of the global GDP. If you can drive even a small change on that scale, you are affecting business throughout on the entire face of the planet. So, I think that the scale of the engagement and the opportunities for leverage that stock exchanges might have are particularly provocative in terms of getting something done.
That's great, Evan. Thanks for that. And so I want to go a little deeper into that. You mentioned a couple of exchanges, and you mentioned Brazil and South Africa. Can you give a little bit more of information as to what's going on there, since they are slightly smaller markets?
They're smaller markets. There's much more direct government intervention in the market. There's much more highly regulated aspect to their operations. So They made the decision to mandate environmental reporting in particular, but also some social and governance reporting as a condition of listing. And they have been doing that for several years, and in some ways they've been the leader in that space. And they've had some success with it. I mean, we're learning from their example, pro and con, for the other exchanges. Like I said, the particularities of their market do not fit everyone. You know, that's not what Hong Kong deals with necessarily. It's not what Shenzhen deals with. It's not what Nasdaq deals with. So we need to find a way to learn the lessons from those exchanges with those listing rules, take the good, and figure out how to pragmatically get the same results without necessarily being as interventionist in that market. But, you know, we're open to good ideas wherever we can find them, and they have certainly been providing them for a number of years. And I think that you're talking about exchanges where the number one priority used to be IPO development and getting small companies to go public and get through the pipeline, and being ever mindful of the amount of regulation that exchanges in particular levy on companies and not wanting to sap their momentum. And that is absolutely still top of mind. And that's not just for us, that's for a lot of the other large exchanges. So we're trying to find a way to navigate between the information that we believe investors have a right to and that should be in the mix without putting these artificial brakes on the development of public companies and their ability to run their company without having to be overburdened with the resource needs of disclosure.
That's a very timely response, because I had a question come in. And again, all of you on the line, you're muted, so you can't ask a question directly over the phone, but you can type in through the instant messaging feature. And so, you know, here's a multinational corporation domiciled in one place, doing business in multiple other countries, multiple listings on different exchanges probably as well. And not only that, everybody and their brother is now asking this company to report. And there's a whole morass of things out there that companies can be doing, and you, Nasdaq, yourself, are reporting on your own sustainability performance. So, Evan, from a point of view of as a reporter, how does a company make sense of this? Now I've got to listen to what Nasdaq wants me to do. What about this regulatory body over here? The mayor where my headquarters is asking me to do this, blah, blah, blah. The list goes on. Can you help them out?
I think it's a real concern. I think that you've got this sort of perceived alphabet soup of frameworks, SASB, IARC, CDP, GRI, and you know, a number of these frameworks are working towards harmonization, trying to find a way so that if you report in one particular framework, your answers work for all of them and an index that correlates them. But that work has been slow and ongoing. I think that you have exchanges getting into the mix and really being mindful of not wanting to add to the regulatory burden unnecessarily. But we think that there's probably some expertise that we can provide. The emphases that we put on company performance in terms of ESG are not exactly the same as the emphases that investors might put on companies. They're not exactly the same thing that regulators and customers might put on companies. So we have a particular industry point of view that we're trying to understand, build consensus on, and assert, and we think it's an important conversation to have with listed companies, that, you know, as your market of choice and as the market that is interested, perhaps even most invested in some ways, in committing to your long-term health and development, these are things that we think are important and that are important to our industry. And, you know, it's the kind of thing where we think it's important. We're starting to train companies that before they go public. You know, we are working with entrepreneurs. We have a long history in Silicon Valley. We work with companies before they go public to try and build them into great companies prior to that part of their growth. So it's important at that stage. It's important, you know, when they're young, and it's important when they're mature. But I totally understand the point, and I've heard it from a number of other points of view that, you know, there's survey fatigue. You know, a lot of the supply chain surveys cross the same lines. There's reporter fatigue and framework fatigue. There's a lot of asks from different angles for the same information. So I think that there's got to be a drive towards harmonization. I think that the exchange effort can, in itself, be sort of a harmonizer of these ESG metrics. I think the exchange asking for something or giving guidance on something will sort of sort out some of the debris from the frameworks and provide companies with a clearer understanding of what we think is most important for them. But it's going to be an issue going forward as long as you've got these viable frameworks out there that are asking similar questions in similar ways, but not the same question in the exact same way. And just very quickly, you mentioned the EU regulation. You no longer are in an isolated market or an isolated economy where you won't be caught up in these sort of regulatory nets or this sense of scrutiny, because the EU regulation will absolutely affect companies that aren't based in the EU, just companies of a certain size that have a presence there. More and more nowadays, companies are global companies, as you say. You might have investors on multiple markets. There are all kinds of different ways that sustainability reporting will float into your worldview, whether you are based in the United States or not. So that's something that companies should keep in mind, too. There's not an isolationist sort of action policy here that's going to work, I think, going forward.
So we're going to introduce the panel in a second, but I do have one follow-on question around that, Evan. You know, having been at this for quite a while, many years now, and having done different work with standards and alignment and harmonization, there always seems to be some next chapter, some next group that comes along and says, well, we're going to look at the landscape and we're going to then make a decision. So it feels a little bit like now World Federation of Exchanges is stepping in. There's been 30 years worth of work out there in sustainability and identifying metrics. We showed a bunch of the different aspects and topics out there. Is there going to be a real hard look at harmonization from the World Federation of Exchanges? And when might you actually, when might we actually start to see some of the ESG topics that the Federation of Exchanges might be looking at? Or are we already seeing them through some of this research that's out there?
Well, some of the research is out there. I definitely think you'll be seeing more work product this year. We are, bound by our commitment to the members of the WFE to provide that information to them first, and that timeline is this year, and then perhaps it will go public sometime after that. But I think that this year it'll happen. I think you'll see this guidance publicly in one way or another. And I agree that, we don't want to just pile on top of this sort of 30-year trend. I think that what's happened in ESG is that you've got the maturing of different factors. 30 years ago, environmental metrics were new and different, and now, the environmental part of ESG is the most mature. So you've got a sort of consensus sense of mainstream understanding around emissions and energy intensity, et cetera, that wasn't there 20 or 30 years ago. I think that governance is fairly mature. You've got governance structures and board policy and oversight controls that are disclosed in lots of places, and that is sort of mainstream. I think the S, the social part, has lagged behind, and I think that's where you're going to see some of the most interesting developments coming forward. I think in harmonization, and as these different groups come together and look at ESG, S is going to get a little bit more attention because S is traditionally the hardest to quantify. S is sometimes the most controversial aspect of ESG, and I think that having some guidance from an interested party like an exchange, or from an interested party like an NGO or framework or investor coalition on the S is the kind of guidance that companies need, because I think that that's still the most murky part of the ESG picture.
Great information, Evan. We got more questions rolling in about the World Federation of Exchanges, but we're going to hold those for now. I want to get into some discussion with the panelists. So if the panelists could unmute their phones, because I would like you to introduce yourselves, explain a little bit about your role and why it even exists at your organization so that the audience understands it. I want them to hear your voices too. And then we'll start to go into some Q&A with you individually. So starting with Morgan Santos Steve, I hope I pronounced it right. Sorry, Miguel Santos Steve. Can you please introduce yourself and explain your role at Nasdaq and a little bit more about what you do there?
Sure. Thank you, Mike, and thank you everyone for attending our webinar today. My name is Miguel Santos. I am an Associate Director for Responsible Investment and ESG Research at Nasdaq Advisory Services. I have worked with investor relations clients since 2008, helping them understand the importance of environmental, social, and corporate governance standards, and also helping them prioritizing the investors' outreach programs. Our clients are therefore global listed companies, and as a leading stock exchange operator in several markets, bringing investors and companies together is part of our DNA, as my colleague Evan Harvey was explaining just earlier. So yeah, that's in a nutshell the description of my role at Nasdaq Advisory.
Thanks, Miguel. Michelle, can you explain your role at BlackRock?
Hi, yes, my name is Michelle Adkins, and I head up BlackRock's Corporate Governance and Responsible Investment team. And basically, BlackRock has this function which is responsible for engaging with the public companies that we invest in on behalf of our clients, because we think that governance issues in particular, but also environmental and social issues, which we see as a subset of governance issues, are long-term aspects of value creation. So, to put it in a nutshell, when a company has good quality people on its board and the board demonstrates engagement and good leadership, when you have quality people running the company in the executive management, when you have good processes around your operations and things like accounting and audit and so on, all of these things are likely to lead to a more successful company over time. And the majority of our clients are, well, they cover the spectrum really from retail investors in mutual funds all the way through to major public pension funds, corporate pension funds, and sovereign wealth funds. And the only thing that they all have asked us to do in common is earn a return on their assets. And we see our corporate governance role in this way of ensuring that companies are well led and well managed supports that demand. Then for those clients who have specific mandates with us where they want to see environmental or social factors in particular incorporated into their investment strategies, we can do that for them in segregated accounts. So there is a broad spectrum. The other thing that the majority of our clients all have in common is that they're long-term investors. So they're saving for very long-term financial goals. And that, again, reinforces the way we think about governance and our engagement with companies. So I hand it back to you, Mike.
Thanks, Michelle. It's a very insightful introduction of what you're doing there at BlackRock. Morgan, next is up to you. Explain what you're doing there at Bloomberg.
Hi, I'm Morgan Tarrant. I am currently an ESG data analyst, and we have a global team that reviews the information that companies are reporting in a range of filings, including corporate responsibility reports. And we've mapped that data since 2009 when our product started, right alongside the fundamental data, so that analysts that are Bloomberg clients and use the Bloomberg platform can aggregate and see quantitative and some non-quantitative information in a way that they're used to seeing, as well as pulling it into a range of analytics. So as a data aggregator, we focus on our global coverage and looking for companies that are disclosing in a robust way and making that data available to our clients. We also engage with clients that are not just investors, but researchers and universities, as well as consulting groups that are looking at this data set as well. So we're pretty involved at the industry level, I would say, particularly with Sustainability Accounting Standards Board, as well as a few other industry groups, mostly advocating for stronger disclosure, helping companies do things like benchmark and see who among their industry are disclosing various data points and indicators that might guide disclosure in the future.
Great, thanks, Morgan. Yeah, appreciate that. So then if I kind of can echo some of the things that I've heard here and the reason for this call, looking at the list of close to 300 people that have registered for today, a great collection of Nasdaq-listed companies are in there, as well as potentially Nasdaq-listed companies. What I'm hearing is that Nasdaq and the World Federation of Exchanges are all very interested in these topics. They've been looking at listed companies to see what kind of disclosure is out there, kind of assessing the lay of the land. As that occurs as well, more and more interest is falling on these ideas of ESG or sustainability. Companies are certainly getting those questions. In fact, some companies are complaining about survey fatigue. Companies that are a little bit more advanced are actually looking at this as a strategic opportunity to engage suppliers in this discussion and doing a lot of really interesting things. Then we have large groups of what we consider public pension plans or sovereign wealth funds, the stewards of capital that we consider public money, who then hire a supplier, an asset manager like a BlackRock to come in and help them look at these issues in more detail. And then someone like a BlackRock might subscribe to something like Bloomberg and use that type of tool to help them really dig into some of the details. And the beauty of this is we've got some great recent information from Bloomberg that we're going to show you in a second or two. But I want to start with Michelle, because you sit kind of in the middle of things here. You've got a lot of really smart people there around you. You've been looking at this, traditional risk issues for a long time. You're looking at long-term returns for your clients and have been for a long time. There's this new kind of bubble coming up in the marketplace where more and more entities are asking you some questions about non-financial performance. Give us a little bit more detail about your day-to-day life. What's going on there? Who's calling you up and who's talking to you? I know you probably can't name names, but give us a sense of what's happening in the marketplace, a little bit more detail if you can.
Sure. So as I mentioned a moment ago, we have a very broad spectrum of clients. So we have those who really do have a very specific and well-informed interest in what we're talking about here as ESG indicators or integration of ESG factors into their investments. And the range of interest in that particular group it covers the types of funds who want us to talk to them about how we integrate environmental, social, and governance factors into our conversations with companies, so our engagements, and increasingly how we're doing that in relation to our active investments. Then we have quite a big cohort of clients who I'd call generally interested. They see this as a hygiene factor. They're pleased that we're doing it. They're not deeply knowledgeable about it, but certainly they get very concerned when they realize that a company that has done something that it gets media attention and usually because it has a negative environmental, social, or governance outcome, that company is in their portfolio. And then they want to talk to us about, did we know about this? Have we been seeking change at the company? And so on. So they generally see it as a hygiene factor. When something goes wrong, they want to know more. And then by far and away, the largest cohort is the silent majority. And this isn't to say that there's no interest. We just don't know if there is interest in that group. And that is the group where I've seen the biggest change, where people are sort of coming out from quite surprising places, if you will, or quite surprising origins, and asking about how they can take environmental, social, and governance factors into account in their investment thinking. And that's something that my team spends a lot of time on talking to companies, to clients rather. And then the driver, though, of BlackRock's program, regardless of the client interest, is what I mentioned earlier. We see being an active investor in the sense of actively engaging companies as a core part of our fiduciary duty to our clients. And that's principally because a lot of those clients are long-term investors, but it's also informed by the fact that a really significant majority of our equity investments are made through index tracking strategies. So our clients are buy and hold investors into the indefinite future. And ESG factors are things that play out over time. And they're nearly always the tail events. So you don't usually, I think one of the issues that we've struggled with as investors is trying to link ESG to alpha generation, so to outperformance. And I think that at some level that's a little bit of a fool's errand, particularly with the level of disclosure we have right now. But where you do see it is companies that have strong practices in relation to ESG, just as they have strong practices in relation to their financial controls and so on, they tend to bounce back quicker when the inevitable sort of event does happen, because we're very realistic, events happen. And also they have fewer of them, so there's less volatility there. And so this is why we believe it's important for us to engage with companies on these things across the entire universe, and whether or not clients have specifically asked us to. Does that get to your point, Mike?
That's a great response. I got a couple of follow-ups that have come in, too. We hear repeatedly from companies that investors don't ask these questions. Why is that? Is BlackRock asking these questions directly?
I think companies often expect to be asked this question in a way of like someone putting up their hand and saying, can you tell me about your ESG standards, please. And very few investors are going to do that, particularly portfolio managers. But portfolio managers are constantly assessing the performance of management and the merits of the approach that executives are taking to managing the company. And for companies with significant exposures in relation to either their environmental impacts because of the nature of their business or their operations, or social factors. And it depends how you define social factors, but at one level, every company has a number of different social impacts, and one of them is, human capital management, the people who come through the door every day. Another one is their reputation in society or the community in which they operate, and another one is their relationships with any regulators. And these are not necessarily thought of as ESG issues. So I think we sort of have a little bit of a language barrier here. But I can tell you, if a portfolio manager learns that a company has fallen foul of its regulator and the relationship has broken down and sort of material fines are going to be coming as a result of that, then I think that is clearly both financial and a concern to a portfolio manager, but they're not going to call it an ESG issue. They're going to say, where's my dividend gone? And I think we've got to be careful about presuming that because a question isn't framed in an ESG context, it doesn't have that, some element of that in its.
That's great, Michelle. Thank you for that. I've got a lot of questions coming in specifically for you, Michelle, but I think we might just have to hold that for another webinar because we want to get to some other content. I'm going to move over to Morgan, and Morgan, BlackRock probably subscribes to you. They probably subscribe to a variety of other services, and they also have their own smart people in-house that are looking through these things. Bloomberg sits in a really interesting spot in the marketplace. You love to provide data. Not only that, you're a privately held firm. You produce your own sustainability report because Bloomberg itself feels these things are important. It itself identifies its most material ESG issues for the operations of the company. But you're reading and looking through thousands of disclosures from companies around the world. Now, I'm going to flip forward to a slide that Morgan has provided us so that you can start to see what's going on out there. And Morgan, if you could, take us on a little bit of a deeper dive into what's going on a daily basis in your life and what a company should be thinking about if they're listening in on this webinar today.
Sure, thanks, Mike. This data is ranges across the environmental, social, and governance categories, and much like Michelle was just saying, these tend to be indicators of strong internal control and the way that risk is being managed internally. So we've built a data set that we think is helpful for investors to identify those risks across the environmental, social, and governance pillars. And here on the slide, we're looking at some tools, just some snapshots of both Excel-based tools and tools that we have on the Bloomberg platform for investors to be able to draw out insights from the larger data set, which is the raw data that companies are publishing in regards to some of these things. So we have an Excel-based scorecard that's very user-driven and customizable. We have a pay-for-performance analysis, which highlights deviation from industry mean on executive compensation and pay, which is the topic of interest as we're into the proxy season now. And we have a corporate governance analyzer, which I've put a snapshot, an overview of some indicators of board composition, diversity, holders of the company shares, et cetera. And then on the bottom right-hand corner, just an example of the range of news trends and charting capabilities we have. Bloomberg is the biggest aggregator of news, and so that, as Michelle mentioned, also, is a great way to stay on top of and in front of things that are flagged as ESG risks, but may not, may use a little bit of different language. So all the news searching that you could do on a specified universe, whether it's a portfolio or an investable universe, those things are very commonly things we help clients set up and customize for themselves. So that was an overview of the tools, and now we're looking at sort of an industry-level analysis. So this is from our Bloomberg Intelligence Industry Dashboard for packaged foods. Something Michelle mentioned is an industry that touches our lives on a daily basis, and even at this subsector level, you can see we have an ESG tab. I've expanded this one indicator under resource efficiency, but there are a number of ratios we have here, both under resource efficiency and other social and governance headers. But this, for example, is a way that you might be able to see energy intensity per sale. So we're normalizing for the size of the company and maybe growth in operations over time. 2013 was the latest full reporting or full data set that is reported on ESG metrics. And this indicator is being shown as megawatt hours per millions of units of currency in which the company is listed. So this is a global set of peers, but you could narrow packaged food companies just in North America or just in Europe, or kind of adjust the peer set. But I thought I would give an overview here of how the data is being shown. And again, here, this is similarly a relative valuation tool where you can start with a single security and reference its peers based on various classification systems. You can use the Bloomberg Industry Classification, which is very revenue-driven, driven by the revenue-generating sources that companies have. Global Industry Classification, which is very common, and a few others. So this is a peer set that we're able to start with Kellogg's and its peers, and then we can see a number of data fields at once. You can build a custom template or just reference some of the data fields. So here you have market cap normalized for US dollars. We have environmental supply chain management, which we look for in company disclosures. 1 would be a yes and 0 would be a no. So that's an example of a Boolean field. We have energy intensity per sales, greenhouse gas, or if reported as CO2, emissions intensity per sales. We have an instant rate, and percentage independent directors on audit committee, which is also an indicator potentially of strong internal control, as well as whether the data has been verified by a third party and who that assurance auditor was. So this is just another example of how you can see data on the industry level.
Thanks, Morgan. Some very insightful information there. So in light of the amount of time left, we've got a lot of questions coming in, but I'm not going to be able to get to them. What I do promise to do is get the questions to our panelists, and we'll respond by email to those of you that are written in. Please feel free to keep writing in. But I want to get over to Miguel, because Miguel, in a sense, and pardon the baseball reference, but you're going to back clean up here, Miguel, and it's perfect kind of position, because before Evan introduced me to you, I had no idea that your role even existed there at Nasdaq, although it makes perfect sense that it would exist. So companies see this kind of information. Companies tune into today's webinar. Companies are getting inundated with questions in the investor relations box. And these people might not understand the language. And they're asking you, they're turning to you, their exchange, hey, Miguel, can you help me out with this? What's going on in your world? Are companies coming to you and ask you lots of questions about this, and how are you reacting, and what are you doing to help them?
Sure. So being the ESG specialist in a team of more than 100 analysts servicing listed companies globally, we help our clients understand who is buying, who's selling the stock, the reasons why, and particularly who they need to meet out there. And of course we know, and it's clear throughout this presentation, that one of the main drivers in recent years for investors either deciding to buy or sell the stock is, of course, ESG. So another thing I wanted to highlight is that our clients are not only those listed on the stock exchanges we operate, such as the Nasdaq in the US or in the Nordics, but also in many other markets, such as here in the UK, Germany, France, Australia, Hong Kong, etc. And for this reason, we have a global presence that allows us to work more closely with our clients. Our own data indicates how quickly responsible investments in the equity markets have grown over the last 4 years. They've actually quadrupled to $2 trillion by the end of 2014. And this is just to give an idea to our audience on how relevant responsible investors have become. Just to give you another figure, in average, they currently own more than 10% of all the shares managed by institutional investors in European listed companies. This is remarkable, as this growth has taken place at the same time as companies are focusing more than ever before on sustainability as a key competitive advantage. But of course, companies need to know who they need to talk to and who the ESG audience is among investors.
So you're saying that companies do recognize the relevance of communicating on sustainability, or the majority don't quite get it yet?
Absolutely. I would say companies see the relevance more so than ever before. I will mention a recent global study that we conducted on best practices on sustainability communication, and this is a study anyone can download from our website. So we basically asked more than 500 publicly listed companies on their views, and the study revealed that 2/3 believe that the company's environmental, social, and corporate governance performance matters to investors. This, of course, includes things such as CO2 emissions, climate change risks, executive compensation, or health and safety standards, etc., etc. So what we're also seeing is how communicating ESG is quickly becoming an essential part in the roles of senior executives and investor relations officers. There's another study that, if I'm allowed to mention this one, I recommend to our audience, and this is the study entitled From the Stockholder to the Stakeholder. This is a meta-study conducted by the University of Oxford and Andreas Feiner of Arabesque Asset Management, which makes a very strong case for the integration of sustainability for both, or by both, investors and by companies, which clearly emphasizes the message that these can enhance portfolio returns and company results. On the topic of engagement, there's evidence that suggests that the dialogue between investors and companies can lead to an average annual alpha of more than 7% following successful engagement. This is, whenever I get an opportunity to talk to companies, I always emphasize this message. This is a great time, a great opportunity to engage with investors, to showcase your sustainability credentials, and basically getting out there on roadshows, taking senior management, because there are more and more investors listening to these messages.
That's really great, Miguel. Thanks for the insights there. I hadn't realized that kind of activity was happening there, and I would suspect, if I wouldn't be going too far, that other exchanges around the world are probably doing similar things, since Evan's part of a group that's talking about this at the World Federation of Exchanges. We're getting down to the last 5 minutes. I want to kind of point out a couple of things about, at least from my vantage point of listening in and hearing what's going on. First, I'm going to ask Morgan to explain this graphic for us. But in essence, here's what we've gone through today. The stock exchanges, like Nasdaq, are grouping up together, talking about things in their association. That association is the World Federation of Exchanges. They're interested in this topic. They're kicking around the idea of transparency in listed companies and in listed companies on their own exchanges. They're looking at this. Others are looking at this. Outside of the stock exchange world are the asset owners and the asset managers. The asset owners being large sovereign wealth funds, large public pension plans, large public entities like TIAA, CREF, CalPERS, CalSTRS, etc. those entities are asking their suppliers, their asset managers like BlackRock and many others, hey, can you help me figure this out? All of them have the opportunity, and many of them do subscribe to Bloomberg, and so they can tune in and see what Morgan's been working on. Not only those 5 or 6 columns you saw there, but I believe, Morgan, there are probably more than 150 different columns that would fall under the ESG umbrella. But
Yeah.
Morgan, can you explain a little bit about this particular graphic here as we kind of start to wrap the conversation up?
Sure, certainly our data set is a little bit broader than what I was able to show today, but this is just to get a sense of what the total return percentage difference is between the MSCI Developed World Index and the 791 companies within the index that are either reporting within the GRI framework or have an ESG disclosure score of greater than or equal to 22. It just gives some idea of the more robustly reporting companies and the way that they're performing over time.
Great, thanks for that. So the last few minutes of the call, we had a lot of questions come in. Like I said, we'll field those questions. We'll get them to the fellow panelists and get some responses out to you all that are written in. I want to close it, though, with comments from each of you, the panelists, and we'll end with Evan. But starting with Miguel, if you could say, what do you feel if you're a company listening in on this call, what's the takeaway?
In a nutshell, the takeaway is that this is the right time. This is a great opportunity for them, first of all, to break down the silos, the internal silos, to learn from the corporate responsibility team, all the key strengths of the company, also work on the weaknesses, but get out there, get on the road shows, and speak to investors, because more and more we're seeing that this makes a difference.
Thanks, Miguel. Morgan, for you, what's the takeaway? What should a company walking away from this webinar be thinking about next?
I would say thinking about what might be material for your company to be reporting, or what your peers may be reporting. Listen for ESG questions that aren't, as Michelle said, aren't framed specifically at or flagged as ESG questions. And maybe see among your larger shareholders which may be looking at ESG risks that you may not have been aware of that are considering those things.
Thanks, Morgan. And Michelle, slightly different question for you, because in some cases you're talking to companies directly, in some cases you're dealing with asset owners asking you questions. There's a lot of debate right now going on out there in the world. I would like you to give us 2 takeaways, one from each side of those people you're dealing with, but also a little bit about this question that keeps popping up about divestment. People seem to be running away from certain industries. Can you elaborate a little bit within the last couple of minutes of the call?
Oh yes, there's no challenge there. Divestment's a sort of 2-hour webinar of its own. But in any case, so I think the key message I'd like companies to take away is not to think of this as something that's in a silo off to one side, but really think about the company in all the aspects of how you demonstrate that you are managing the company well over time. Because one of the things that ESG factors give shareholders a sense of is some of the more operational aspects of the business model. And so understanding that helps investors understand the long-term financial sustainability of the company. So don't think about it as a silo. Think about it as something that is embedded across everything that you're doing as a company. And to address the point of, our investors never ask, well, if the investors didn't ask about your dividend policy or your strategic direction or the milestones that you've achieved towards your strategy, you wouldn't sit there silently. If you think it's material and it's important and it will help investors understand how well you're doing as a management team, then you should initiate the conversation around these factors. And I think, a lot of companies do talk about their culture, the importance of recruiting good people, for instance, as one tiny slither of the range of topics that could be covered. For investors, I think the most important thing is to have an investment framework for this. One of the things that we find a little frustrating is we have clients who have never really thought about ESG, and then they suddenly come to us and say, we want to green our portfolios. And they haven't really thought through what that means, what risk-return sacrifices they're willing to take, and really, half the time they've not even checked in with their constituents or their broad base of constituents, not just the most vocal constituents, about how to think through these things. So to the extent that clients want to integrate certain aspects of ESG into their investment, they need to do it within an intellectual framework that provides the basis for all future decisions in relation to this, rather than reacting piecemeal to trends that are out there in the marketplace. And that kind of leads into the next thing you asked me to talk about, which is divestment. Because a lot of people are looking at divestment. And really, I believe that it's important that if a fund wishes to divest, they are very clear that that decision is taken in the context of the board or whichever governance body is taking that decision within the context of their mandate. Because again, responding just to the most vocal members of your beneficiary group can be, I believe, quite dangerous if it turns out in hindsight to have lost the fund's money. So there has to be a sensible way of taking that decision. And there, so for instance, for a nurse's pension fund not investing in tobacco could well be considered a very natural extension of the mandate. But I think for your average university fund, it isn't necessarily obvious to divest from fossil fuels, for instance, which is obviously one of the most high-profile divestment campaigns right now. It takes a lot of thought and I think justification.
I think you're right. I had to spring that on you at the very end there, Michelle, but it could be another 2-hour webinar, I'm sure, on that. Maybe that would be one of the other ones we do with Nasdaq and Evan in the future. I want to thank Morgan, Miguel, Michelle, and Evan for a great content, great session. We got a tremendous turnout. We got tremendous hang rate, lots of questions. We'll get back to you on responses. Evan, over to you.
Thanks, Mike. I think it's been a great call. The first of 4 this year. Hopefully we will have just as much information and content expertise on the next 3. If you have suggestions for future calls in the space, please let us know because we are planning these throughout the year. I'll just close by touching briefly on a point that Mike and I talked about in the beginning, is that one of the reasons Nasdaq is involved is because we are persuaded that there is a connection between ESG outperformance and financial, operational, and strategic outperformance. That's the bottom line. We want to attract great companies to the exchange. We find that this is one of the ways that companies can demonstrate that their greatness. And I agree with Miguel that studies that are out there, like from the stockholder to the stakeholder, make the point very convincingly. So take a look when you have a chance. Send us questions if you have them, and come to future webinars to join the discussion because we would love to have your point of view. Thank you very much for joining.